The moment you realize Wall Street's silver short is breaking, everything changes. Not slowly, not quietly, but like a dam cracking under pressure. Suddenly, the market stops behaving like a calm ocean and starts acting like a storm. In the next few minutes, I'm going to explain exactly why the silver short is collapsing, why the price could explode past $100 soon, and what you should watch for in the next weeks. If you stay with me, you'll understand the hidden forces driving this, and you'll know what the mainstream media is missing. Welcome to Silver Reset. And if you're new here, make sure to hit like and subscribe now, because this channel breaks down the silver story the way Wall Street doesn't want you to see it. Also, if you find this video useful, hit the bell so you don't miss the next update because things are moving fast. Let me start with the most important idea. A short position is not just a bet. It's a promise that you can deliver something you don't actually own at a future date, at a price you choose today. In simple terms, Wall Street has been selling silver they don't own, hoping the price stays low long enough for them to buy it back cheaper later. That's how shorts work. But when a short becomes too large, the market starts to behave like a tightly coiled spring. The more the price rises, the more pressure builds. And when that pressure becomes unbearable, the spring snaps. That snap is what we are watching right now. For years, silver has been treated like a quiet, boring market, something only serious investors and collectors cared about. But behind the scenes, the real story is that silver is the most manipulated commodity on the planet. Every major move in price is met with intense resistance from institutions that have a huge interest in keeping silver cheap. The reason is simple. Silver is not just a metal. It is a key industrial material, a strategic asset, and for many nations, a backup currency. When silver rises, it exposes how fragile the global financial system really is. That is why the short position has been so massive, and why the current situation is so dangerous for the shorts. Now let's talk about the mechanics of what's happening. When a short is created, the seller borrows silver or borrows the right to deliver it, and then sells it into the market. If the price drops, they win. But if the price rises, they start losing money every day. This is where the danger begins, because losses on shorts are unlimited. A long position can only lose what you invested, but a short position can lose everything and keep going. That is why shorts are always pressured to close before the price goes too high. And that pressure creates a feedback loop. As prices rise, shorts buy back silver to cover, which pushes the price up even more. This is called a short squeeze, and it is exactly what we are beginning to see. So why now? Why is the silver short breaking at this exact moment? The answer is not one single event. It's a combination of rising demand, shrinking supply, and growing distrust in paper markets. On the demand side, global silver consumption is rising, especially in industrial sectors like electronics, solar energy, and medical equipment. Meanwhile, physical silver supply is not keeping up. Mining production has been struggling, and above-ground inventories are shrinking. When demand outpaces supply, the price has to rise. And that is a natural market force that no paper contract can permanently block. But the real trigger is the collapse of confidence in paper silver. Paper silver means futures contracts, ETFs, and financial products that represent silver, but do not necessarily correspond to physical silver held in storage. The problem is that the paper market can grow far faster than the physical market. Wall Street can sell millions of ounces on paper, but those ounces don't exist in the real world. As long as prices stay stable, this illusion works. But when prices rise and investors start demanding physical delivery, the paper system begins to show its cracks. That's what we're seeing now. You might be asking, how do we know the short is breaking? The most visible sign is the price action. Silver is starting to move with momentum. Not slow, not gradual. Fast, sharp, and decisive. That is not typical for silver. Silver is known for long periods of sideways trading, followed by sudden spikes. But what makes this different is the consistency of the upward pressure. The market is not just bouncing, it is charging. And charging markets are usually driven by real buyers who want physical metal, not just traders chasing a chart. Another sign is the increasing gap between the paper price and the physical price. When physical silver becomes scarce, dealers start raising premiums. You can see this in higher premiums for coins and bars, longer delivery times, and dealers being out of stock. That tells you physical demand is real and urgent. The paper market can pretend the metal exists, but the physical market doesn't lie. If you have ever tried to buy physical silver recently, you know what I mean. The supply is tight, and the prices are moving higher. Now, let's talk about the biggest risk for the shorts: forced liquidation. When a short position starts losing money, the trader has a few options. They can add margin, or they can close the position by buying silver. But if the price rises quickly, the trader may not be able to add enough margin, and their broker can force them to cover. That forced buying creates a cascade effect, because when one trader is forced to buy, the price rises, forcing others to buy, and so on. That is a short squeeze, and it can move the price much faster than anyone expects. The key point here is that the short squeeze doesn't need a perfect trigger. It just needs a moment where enough shorts feel pressure at the same time. That moment can be caused by a single news event, a sudden jump in physical demand, or even a large buy order that shocks the market. Once the squeeze begins, the market can move violently because the shorts have to cover quickly or face massive losses. This is why $100 silver is no longer a fantasy. It is a real possibility if the short squeeze accelerates. Now, I want to make something very clear. This is not a guaranteed prediction. Markets can be unpredictable and silver can be volatile. But the structure of the market is changing, and the odds are shifting in favor of the upside. When a market is manipulated for years, and then the manipulation starts to fail, the rebound can be extreme. Silver has been suppressed for decades. That suppression has created a buildup of demand that cannot be satisfied by supply. When the short breaks, the price will rise not just because of buyers, but because the shorts are forced to buy. That is a double push upward. To understand the potential magnitude, we need to compare silver to other assets. Gold is often seen as the safe haven, but silver is the more volatile cousin. Silver tends to move faster and harder because the market is smaller and less liquid. A relatively small increase in physical demand can have a huge impact on price. That's why silver can spike in ways gold rarely does. The $100 level is not a random number. It represents a level where the market could finally recognize silver as true value, as both a precious metal and an industrial necessity. And let's not forget the macro environment. Central banks are printing money, governments are expanding debt, and inflation is still a major concern. When people lose faith in fiat currency, they turn to real assets. Silver is one of the most undervalued assets in the world right now, especially compared to gold. If gold rises, silver usually rises faster. The ratio between gold and silver has been historically high for a long time. When that ratio normalizes, silver could move much higher and fast. Now I want to address a common question. Why would Wall Street allow silver to rise so much? Isn't the whole point of the paper market to control price? The answer is yes, but control has limits. Wall Street can suppress price only if the market remains confident in the system. Once confidence begins to crack, the market becomes unstable. The paper system depends on the belief that the metal can always be delivered. But if physical delivery demand spikes and inventories are tight, that belief can collapse. When confidence collapses, the system becomes self-destructive. The shorts start losing, the paper market becomes unstable, and the price explodes. This is why the timing matters. We are not talking about a slow, steady climb. We are talking about a breaking point. When a short is broken, it doesn't just go away. It creates a wave, and waves in markets do not stop because someone wishes they would. They stop when the energy runs out. But in silver, the energy is growing, not shrinking. Now I want to give you a simple way to watch for the next big move. Watch the premiums and delivery times in the physical market. Watch the volume in futures contracts. Watch for sudden spikes in open interest because that can signal a large short position is still in place, and watch the price action. If silver starts making higher highs with strong momentum, that is a sign the shorts are getting squeezed. One more important point. Silver is not just a financial asset, it is also a strategic asset. Many countries understand this, and they are quietly accumulating physical silver. When large institutions start quietly buying, the market can shift without anyone realizing it until the price has already moved. That is the silent part of the story that mainstream media never covers. They talk about stocks, bonds, and tech, but they ignore the metal that powers modern technology and supports global industry. Now, I want to bring this back to you, because the reason you are watching is not just curiosity. You want to know what this means for your money. If silver breaks past $100, it will not be a gradual event. It will be a market shock. People who are unprepared will panic. People who are prepared will understand that the market is simply correcting a decades-long imbalance. So what should you do? I'm not here to give financial advice, but I am here to help you think clearly. First, understand that silver is not a short-term gamble. It is a long-term story. If the short breaks, the upside could be dramatic, but there will also be volatility. Second, don't rely on paper silver alone. If you want real protection, physical silver matters. Third, stay informed and watch the market structure, not just the price. The price is the result. The structure is the cause. Before we finish, I want to emphasize one final point. The silver market is changing, and the change is accelerating. The short position is cracking, and once it breaks, the market will move fast. If you're watching this video, you're already ahead of the curve. But the key is to stay calm and focused. Don't get caught in the noise. Focus on the facts. Watch the physical market. Watch the price action. And watch for the moment when the shorts are forced to cover. If you found this explanation helpful, please leave a comment below with your thoughts. Do you think silver will reach $100 soon, or will the market be suppressed again? Your opinion matters, and I want to hear what you think. Also, share this video with anyone who needs to understand what's happening behind the scenes, because this story is not going away. It's only getting louder. And if you haven't already, hit like, subscribe, and turn on notifications for Silver Reset. Thank you for watching, and I'll see you in the next update.